December 2nd, 2001. A company worth $70 billion vanished. Not slowly, not gradually, overnight. Enron. Wall Street called it America's most innovative company. 6 years in a row. 20,000 employees trusted it with their futures. Millions of investors believed every word. But it was all built on one thing, a lie so big, no one thought to question it until it was too late. This isn't just about one company. It's about how the smartest people in the room got fooled, how auditors, regulators, and Wall Street analysts all missed the same red flags, and how a handful of executives convinced the world they'd reinvented capitalism itself. So how did they do it? It's the year 1985. Enron starts as a boring pipeline company, natural gas, infrastructure, nothing sexy. But CEO Kenneth Lay had a vision. Why just move energy when you can trade it? The 1990s changed everything. Deregulation opened the floodgates. Suddenly, Enron wasn't selling gas, it was creating markets, electricity futures, weather derivatives, bandwidth trading. They turned energy into Wall Street products, and traders loved it. By 2000, Enron was the 7th largest company in America. Stock price, $90 per share. Revenue, $101 billion. Everyone wanted in. But here's what no one saw. Enron's revenue wasn't real profit. They were using something called mark-to-market accounting. Here's how it worked. Let's say Enron signed a 20-year energy contract. Normal companies record profit as they earn it. Enron, they recorded the entire future profit immediately, day one. So a deal that might earn $100 million over 20 years, boom, $100 million profit. Today, even if the deal failed next year, on paper, Enron looked unstoppable. In reality, they were hemorrhaging cash. Now here's where it gets darker. Enron had a problem. Debt. Billions of it. And if investors saw that debt, the stock would crash. So they created a solution, special purpose entities. Fancy name for shell companies. Here's the scheme. Enron would create a fake company, transfer their debt to it, and hide it off the books. To investors, Enron looked clean. To regulators, everything seemed legal. But here's the twist. The executives running these shell companies, Enron's own CFO, Andrew Fastow, he was literally making millions from companies designed to hide Enron's losses. Conflict of interest? Fraud? Both. You'd think someone would notice. Auditors, analysts, the SEC, but no one did. Why? Because Enron controlled the conversation. They hired Arthur Andersen, one of the big 5 accounting firms. They paid Wall Street analysts to hype their stock. They intimidated journalists who asked hard questions. Enron's PR machine was relentless. We're the future. We're digital. We're disrupting energy. Employees believed it so much, they invested their entire 401ks in Enron stock. Meanwhile, executives were quietly selling millions of shares. The illusion was perfect. Until one person asked the wrong question. March 2001. Bethany McLean, a Fortune reporter, publishes an article. Is Enron overpriced? Simple question, but Enron couldn't answer it. CEO Jeffrey Skilling called her unethical, but she kept digging. Then, in August, Skilling suddenly resigns, no explanation. Suddenly people started paying attention. A whistleblower inside Enron, Sharon Watkins, sends a letter to Kenneth Lay. We're an elaborate accounting hoax. Lay ignores it. The SEC starts investigating, and the dominoes begin to fall. October 16, 2001, Enron reports a $618 million loss. Stock drops. October 22nd, SEC launches a formal investigation. Stock drops further. November 8th, Enron admits it overstated earnings by $586 million. 4 years of profits erased. The stock is now $9. Panic spreads November 28th. Credit rating agencies downgrade Enron to junk. The stock hits $0.26 December 2nd, 2001. Enron files for bankruptcy, the largest in U.S. history at the time. From $90 per share to worthless in 56 days, 20,000 employees lose their jobs, $2 billion in pensions gone. The fallout was massive. Arthur Andersen, the accounting firm that helped hide the fraud, convicted, dissolved, gone. Jeffrey Skilling, 24 years in prison. Kenneth Lay, convicted, died before sentencing. Andrew Fastow, 6 years in prison. But the damage went beyond Enron. Congress passed the Sarbanes-Oxley Act, forcing companies to be more transparent. Trust in corporate America shattered, and a new question emerged. If Enron could fool everyone, who else is lying? Enron's collapse wasn't about bad luck. It was about choosing illusion over truth. They didn't fail because the market turned. They failed because they believed their own hype, because they prioritized stock price over actual value, because they thought complexity could replace honesty. Here's what Enron teaches us. Growth without substance collapses. Hype without proof fades. And deception, no matter how sophisticated, always gets exposed. Not slowly, all at once. If you want to understand how companies rise and why they fall, this is where you'll find the answers. Subscribe to WealthOriginsTv, because the next Enron, it's probably being built right now.